Welcome to this Killick Explains video, key investing questions number 3 in a series of 4. And this time I'm going to ask the question that a lot of people ask when they've made the decision from video 1 about how much they can afford to invest in equities. From video 2, they've decided how they're going to do it, and it might be that they're looking at funds for argument's sake. Then they need to decide active or passive. What approach do I want to take to investment? This is quite a big, broad question. So there are 3 ways potentially of investing, essentially actively, which does what it says on the tin, come back to that in a moment, passively, which I guess almost does what it says on the tin, more about that in a moment, and then some kind of hybrid approach which tries to mix and match the two. So what is active investment management? Okay, well, essentially it's all about deciding what you're going to buy. So in other words, where is your money going to be invested? Equities, bonds, cash, property, alternatives. How much are you going to put into each basket? Which individual securities will you then decide to buy? How often will you buy and sell them? And if the portfolio starts to move out of alignment because one part of it grows and another doesn't, and you want a roughly equal weighting across the portfolio, how often are you going to rebalance and how aggressively? Now, all of those are active decisions, if you like. Those are things that either a fund manager can do on your behalf, a portfolio manager can do on your behalf, or if you're feeling confident enough as a DIY investor, you can potentially do for yourself. Now, passive investment, on the other hand, involves no human interaction at all. It's normally fully automated. It involves algorithmic investing. So all of the decisions about asset allocation, about picking individual securities, about how often to balance up, buy and sell what's in the portfolio, that is all automated. So for example, if you are tracking the S&P 500 index, the fund that tracks it will rebalance according to what's in favor and out of favor on the underlying index itself. Now, that sounds attractive in one sense. It's cheap, it's simple, but as we'll come back to in a moment, you don't necessarily want everything that you invest to be held passively. And then there's hybrid. And hybrid investing basically comes in a couple of forms. There are active managers who are not realistically as active as they should be. They benchmark hug, as it's told. So they claim to be active, but actually they've sneaked out perhaps for a round of golf, and all they're really doing with a chunk of your money is following a portfolio, an underlying benchmark that's been established, like an index, for example. And then there are active ETFs, and these are exchange-traded funds set up with a degree of active management built into them, if you like. Passive investing, what are the pros and cons? Well, I've mentioned a few of them. It's simple, it's cheap, okay, and because of that, it's generally cheaper and more efficient if all you want to do is to track a broad index of securities in a well-known established market like the US, for example. Active, on the other hand, can give you specific access to places that are difficult to access any other way. So I'm thinking of emerging markets like India, for example. Even if a passive vehicle claims to give you exposure, it may not, or not in the way you think it does. It may simply hold the biggest companies that have some kind of access to those markets without being directly involved and without holding some of the more interesting names, if you like. You won't beat the market with a passive strategy, but you will with an active strategy, potentially. Not all funds beat the market, but some have the potential to do so. And you have to also ask the question, does passive investing actually always work? You can get inefficiencies in passive investing when, for example, a tracking fund doesn't hold all the constituents of an underlying index. You get tracking error and so on. As for hybrids, I'm not a huge fan. Now let me explain what I mean. Yes, within a portfolio, you might have a hybrid approach insofar as a portfolio manager might, on your behalf, hold equities, bonds and funds, and some of those funds might be passive. There might be ETFs, for argument's sake. That's fine. But as for hybrid instruments, not such a fan, because quite often with an active ETF, you're getting kind of passive performance at an active price, if you like. They're more complicated, and therefore I question whether they're worth the extra money. And some of those active ETFs can bring the cost almost close to the equivalent sort of purely active strategy. So what are my takeaways here? Well, passive investing for a start is a little bit of a myth. I mean, every decision that you make is active. How much cash do I hold? How much do I commit to equities? How much to bonds? Which geographies do I want to invest? You know, these are all active decisions. You can't completely escape having to get to involve to some degree in investment, even if it's just working out your risk tolerance and so on. So I would tend to mix the two where appropriate, but I would always keep an eye on costs, and I would always personally want to know what's under the bonnet in terms of the approach being taken on my behalf. Okay, so lots of information there again. To find out more about this topic and some of the ones related to it, if you like, they're killick.com/learn. Down this side, you've got a shares, a bonds and a funds tab. Not a bad place to start. You've got my how to invest in equities guide sitting over there. It's got a light blue cover, editor@killick.com for that one. And then all of these issues come up from time to time in Confidant. Some of our Killick experts, if you like, talk through some of those angles I've mentioned from a kind of commercial investment perspective. And that again is editor@killick.com.